Resolve Adaptive Asset Allocation ETF, which trades on the Toronto Stock Exchange under the ticker symbol HRAA and is sub-advised by Resolve Asset Management. HRAA is an alternative fund whose investment objective is to seek long-term capital appreciation by investing, directly or indirectly, in major global asset classes, including, but not limited to, equity indices, fixed income indices, interest rates, commodities, and currencies. HRAA gains exposure to these asset classes by investing in derivative instruments that may include future contracts and forward agreements and securities. HRAA will take long or short positions, using up to a maximum of 3 times leverage in asset classes such as equity indices and fixed income asset classes, commodities, currencies, volatility indices, and other alternative asset classes. To learn more about this, please visit www.horizonsetfs.com/HRAA to read about the ETF's investment objectives and important disclaimers about the risks associated with an investment in the ETF.
All right, we're live here with Alex Chalekian. How's everybody doing today?
Good.
Awesome.
First show of the year. What do you got there, Alex?
Let me put this down and grab the bottle here. It's been a crazy week, as we could say, right? So I decided to go with some tequila. This is the Roble Fino from Partida. It is tequila, but it was put in sherry oak casks. So it has kind of the taste of a whiskey. So that's what I'm enjoying today.
Nice.
Tequila. That is, yeah. I guess this week has been worthy of tequila for the Americans, right? And the world, probably.
Sure. I really enjoy tequila, but this is kind of like a double. You know, you get.
You don't even have the rocks on there.
You're
a good man. Jason, what are you drinking today?
I got a Armagnac. I've been known to drink water on this podcast, but with the week, yes, so we'll have some of Armagnac because I'm in the cognac kick here lately.
Yeah, excellent.
I got a beer going.
Oh, Corona.
Nice.
A couple red wine. Nothing too crazy.
Great.
All right. So listen, before we begin, let's just make sure that everybody understands that this is a free-flowing conversation. None of it should be considered as advice. If you need any advice, contact one of Alex's advisors and make sure that you get the right thing that's suitable for you. That if you're in Canada, you might want to reach out to one of us. But just generally speaking, free flowing, and none of it is investment advice. So with that, Alex, we actually met, like a year and a half ago in the LA FinTwit. It felt like 20 years ago, but we were out in the ocean, nice little patio. I had a great conversation. I've been following what you've been doing, but why don't you tell the audience that may not know you, what your journey has been, how you got into the business, and tell us a little bit about your background.
Yeah, shout out to Corey Hofstein that helped put that together. Right. We have our LA FinTwit meetups, which, like you just said, it feels like it's been 20 freaking years since we last saw each other, but those have been fun. I've gotten involved with the Twitter community and everyone kind of gets to know each other, but it's nice to be able to obviously meet face to face. So a little bit of my background. I am the founder and CEO of Lake Avenue Financial, which is an RIA based here in Pasadena, California. I'm coming to you live from my home, which I've been basically in since March of last year. We've done a great job as far as growing our firm over the years, organically, as well as through acquisitions. I'm more than happy to help. I think you guys get a lot of advisors that join in on these live streams. So if there's questions that people have or comments or whatever, more than happy to help. As you mentioned, this is a free-flowing conversation.
Yeah.
So thank you for inviting me, guys.
Hey, man, it's a pleasure to have you, because I think, it's interesting. I think all started, Jason, you were also an advisor back in the day, right? Who with, you're muted.
You're muted, I think.
There we go. Sorry about that. Yeah, Merrill Lynch and CIBC Wood Gundy, way back when, Midland Walwyn in Canada. So I was an advisor for over 10 years. Yep.
Right. So we a lot of us have like background on the advisory practice, and so we connect really well with the advisory space all over the world, Canada, US, globally. And as I've been following what you do, it's really, you really seem to hit the nail on the head in many aspects of practice management. So we wanted to have you on to really talk a little bit about your journey, because it really is, being an advisor is not just about knowing how to give investment advice. It has to do with entrepreneurship. It has to do with organizational skills, people skills, social
Communication
media,
skills.
communications, and you seem to do a pretty good job. I've always found your approach very engaging, and we wanted to have you on to see if you could share some of that insight, as well as like on the entrepreneurial side. I'm really interested in hearing a little bit about your views on building an asset management firm. But just tell us a little bit about what you think Lakeview's and your organization's forte is. Like, what is it that makes you guys unique?
Yeah, before I talk about Lake Avenue Financial, it's funny you mentioned communication. I don't know if my wife Rosa will agree with you on those, but maybe different when it's business as opposed to personal types of stuff. But we're all trying our best, especially given the circumstances. Everyone's kind of cooped up at home, and I got 3 boys. They're older, so they're all doing school from home, and everybody's here. So, anyways,
Wow.
As far as Lake Avenue Financial is concerned, it was a journey to get where we are today. I started in the industry back in '97. I started at a firm, Sun America Securities, which later on became AIG. I don't know if you guys are familiar with that one, but I was a registered rep there, working, trying to learn the ropes. But before I got there, the interesting part about my journey was the fact that I didn't think I was going to come into this industry. I was studying accounting. And while I was in school, I realized that, I really enjoyed investments. As soon as I got to high school, my last economics class in high school kind of got that little tingle in my head of, oh, this is interesting. You can buy companies and be owners and so forth. And I started buying and selling. I had a broker at Dean Witter when I was 18, which was pretty funny. And I would call him up and we would talk about stuff, and Yahoo was going public and we wanted to jump into the IPO and so forth. And then E-Trade came along and started doing some online trading, and then eventually started buying funds. If you guys remember Putnam from back in the day, how popular they were, the Voyager Fund and all this stuff. So it was the rah-rah days before, 2000. And I was very much interested into it, but I thought I was going to be an accountant. So I started studying for accounting. I was working at an accounting firm, clerking with them at the time. And probably one of the best things that ever happened to me in my life was I would talk to the partner at the accounting firm, and him and I would sit there and actually open up the Wall Street Journal that they would get delivered every morning, and we would look at our stocks. Back in the day when you actually looked at the newspaper to see what the closing price was. I know a lot of the millennial and younger.
I don't know what you're talking about.
I'm with
Jason.
you.
Jason was reading the tape coming out.
Yeah.
Easy, buddy.
So we would actually sit there and look at, what did our funds do? What did our stocks do? And he kind of, mentioned to me, he's like, so much about this, maybe you should focus on the investment side of the financial world instead of the accounting side. And I never thought much of it then. I continued on with college. And while I was in school, getting into deep loans and debt, because I didn't come from a family that had money. So I pretty much worked 3 different jobs on campus while I was, going to school. And I sat there one day and I said, I don't really want to work for anyone. So I have 2 options. I can either go into making something, selling widgets where I need all this money and build a manufacturing firm and so forth, or I can go into the service industry. And what better than going into something I'm actually passionate about? I was doing investments for my friends, for my family members, opening up Roth IRAs for them and just to help them out. So I'm like, I might as well get paid for what I'm doing. I'm 21. If I fail, worst case scenario, mom and dad will take me back home. And I was at UCSB at the time. So I was there for a couple of quarters in Santa Barbara, and I left school. I dropped out, got the opportunity to go to Sun America Securities. They helped me get licensed, do all the things. And I was there for a couple of years before I realized this is just a sales job, and I wanted to focus on the financial planning side of things. So I left there in 99, went to American Express Financial Advisors, which is the Ameriprise of today. I was there for a number of years, grew the firm, and I knew that as we were growing organically and I was working with a number of other advisors as part of our group, I wanted to start doing acquisitions. But Ameriprise wasn't the right place to do that. You needed to be independent. A lot of the people that wanted to sell their practices, were other groups or other brokers, and they're like, we don't want our clients necessarily going to Ameriprise or to a captive audience. So we decided to leave and start our firm at LPL Financial in 2003. So we went independent. I started Chalekian Wealth Management, which was what the name of the firm was at the time. Years later, I decided to take my name off the door because I didn't want it to be about me. I wanted it to be about the people. I wanted it to also be about growing the firm because, that's something we could talk about today. A lot of times you see people put their names on the door, but then it becomes an ego issue. And I don't have an ego. I wanted to be the first one to say, rip that name off the door. We don't need that. I want people to want to come here and feel welcome and want to work with the team. So we were at LPL from 2003, and then eventually in 2014 went hybrid under their platform, started the RIA, and then earlier last year, I don't even know what it is, April last year, I decided to drop my securities license. So just focusing on the RIA side. And along the way, we've done a number of acquisitions. We've completed 7 acquisitions, throughout the time period. And the first one I did was in 2008. And once I got kind of the taste of it, I realized what to do. We made a lot of mistakes, but we kind of ironed all that stuff out. We did another one in 2009 and so on and so forth.
Excellent. Why do you, just curious, why did you decide to grow with acquisition versus grow organically? I mean, you have limited resources. You could take one route or the other. What made it more attractive for you to go down the acquisition path?
It's like a quick shot in the arm, but it comes at a price, right? So if you don't have the infrastructure and if you're not set up for it, it could be a disaster. You can buy a practice, and let's say you're a solopreneur, you don't really have a staff or a team. You all of a sudden went from having your existing 100 clients to now you bring on 100 new clients. You doubled overnight, but that doesn't mean that you can't service those people as well as your existing clientele. So there's the pros and cons. But one of the things I noticed is real quickly, you can grow, you can expand. And it was a good diversifier for us as opposed to just the organic growth. And one of the things that a lot of advisors will ask me is like, well, when should I consider an acquisition? And kind of what I will usually look at them and tell them is like, besides market fluctuations, if your firm is growing organically 20-25%, then don't even think about necessarily doing an acquisition. It could probably become more of a pain in the butt than it's worth. But if you're not, then you need to look at acquisitions as an option. Because in this industry, as you guys realize, if you're not growing, you're probably dying. So we looked at acquisitions as one way to start creating a little bit of a bigger group, bring in other advisors to work with those client relationships. Succession planning was something that I've been talking about since 2008, 2009. The first practice I bought actually was from an advisor that literally was hit by a bus, went into a coma. A week later, he passed away. And, on one hand, his wife had to figure out his funeral arrangements. And on the other hand, she had to figure out who was going to be his successor. He was an elderly gentleman. He was actually going to retire the year after. And he had not planned anything. It's always ironic how much little planning advisors do. We do it for others, but we don't do it for ourselves. So
guilty.
Yeah. No, well, look, we're all guilty, right?
It's crazy. The
shoemaker that's got a hole in his shoe.
Most advisors I know still haven't gotten their wills done with their newborns. It takes them 3 to 5 years before they start doing that type of stuff. It really is cobbler's children go barefoot. Right?
Exactly. So
it is super important.
It's interesting to see that. So we had the conversation, and just imagine the timing. This was December of 2008. Okay. This gentleman had 35 plus years in the industry, had helped his clients grow their assets. Now, all of a sudden, he passes away. Markets are melting down. People don't know if the world's going to come to an end. Is the dollar going to be worth anything anymore? And individuals saw their retirement assets get slashed into half. So, and all of a sudden the new guy shows up, right? So now they got to be like, who's this guy? What happened to Don? I had meetings where people were crying because they spent the last 20, 30 years with this man and he took care of them. And now there's this young kid that's going to have to try to fill these big shoes. And it was tough. It was tough. So we had to be very careful in how we handled it. We had to console them. We had to hold their hands. We had to explain them the situation that was going on. And part of them, they were grieving, and the other half of them were trying to figure out what they did with their assets. So it was all hands on deck. And that was our first experience. So after that, I learned like, okay, if we're going to go down this route, we got to bring in more team members. We got to set up our organization to be able to go remotely, to be able to be, scalable. And that was one of the things that we started to implement right away, kind of if you build it, they will come type of situation. And after that, we were able to get another acquisition and kind of just, started to steamroll from there.
What does that look like right now? Tell me a little bit about the organization, the team. What's the team look like, and what are the roles, and how much has changed recently?
Yeah, so we've had a lot of changes over the last couple of years, I would say. Unfortunately, I was in a bad partnership, and then ended that a couple of years back. So kind of the disbanding of what happened there split the firm up a little bit, and not in a legal manner. My ex-partner literally started stealing clients, and we had to go through a whole arbitration, which was another crazy thing altogether. But with that individual, I was able to do 3 different acquisitions, and so we brought all these firms on, and then after a while, it became and we did them all over the place. So we bought a practice in Pasadena, and then we bought another practice up in Las Vegas, which we already had another practice out, so it was easy. It was kind of go out there to meet with clients, and then we purchased another one up in Napa. That again, my wife loves wine, so she's like, oh, I'd love to be able to retire up there or whatever the case is, and have a small practice. So what ended up happening was Alex was on a plane. Hey, I did meetings on Mondays in Pasadena, in Los Angeles. Got on a plane Tuesday, Wednesday was in Las Vegas, Thursday, Friday in Napa, and then kind of went back and forth while he basically sat at the office and played some game on his computer. So the problem became, when I had to have the come to Jesus moment with him and say, hey, listen, I can't be flying around and doing all these meetings while you sit here and play solitaire on your computer. And then that just started to crumble the relationship. And then it was both of our faults. As much as I tried to set the responsibilities and set up what needs to be done from the get-go, it just never came to fruition. So if you're going to build a team, it's important that everyone knows what their roles are and they stick to that. So it was a lesson learned. And that's one of the things. I've made a lot of mistakes. I've made a ton of mistakes over the years, over the 23 years that I've been in the industry. But I'm trying to learn from those mistakes, as well as, through my Advisors Unite platform, is try to make sure that other advisors don't make those mistakes as well. And that's where we kind of talk about pros and cons and tips of acquisitions.
Yeah, so
you mentioned.
Go ahead, Rich.
Yeah, I was just going to ask, in your earlier point, you were mentioning the emotional roller coaster that you can have sometimes with clients. And so it just, I think most people aren't really aware of the psychologist role that a lot of advisors need to play. So it's part strategist, part psychologist. So the behavioral side of things is equally, if not more important, sticking to portfolios, understanding people's tracking errors and biases. So how do you think about that in the context of your practice?
It's more important. I would say it's a lot more important, because as much as if I sit with a client, at the end of the day, they're a human. I can talk to them about performance numbers and charts and all of this, but if I can't connect with them on an emotional level, it's over. They're going to look to go somewhere else, because at the end of the day, a lot of stuff, whether it be us or somewhere else, it could be commoditized, right? So they're going to look at us and say, who can I connect with? This is a person that's going to hold my hand and take this journey with me for the next 10, 20, 30 years. Do I want them in my life? Do they really get me? Do they understand my family, my situation? Or are they more of the technical side, where they're going to say, here you go, here's the chart, this is what it looks like, good luck, we outperform the benchmarks, and whoop-de-doo. So I mean, listen, There's nothing wrong with that if that's what you want to do. But those people are not going to stay with you just because you outperform the benchmarks as much as you think that's what it is. But there is the element of greed. We have to be honest. People are looking about their numbers and they say, hey, if you're doing a good job, as much as you're quirky, I'll stick with you. I mean, just think about some of the professionals you guys work with, maybe other accountants, attorneys, and so forth. You might say they're not the funnest people to hang around with, but they get the job done, or I trust them, or they were a good referral. But if you find an attorney that you can really relate with and gets you and is someone that you want to go and grab a beer with, possibly, right? Then you're going to say, that's the person I want to stick with and work with for a long time.
So, Alex, just how do you think about that perspective of giving them the personal touch as you grow a business larger, right? You're going to have, I imagine, through acquisition, a slightly larger client base per touch, I would imagine. So how do you augment your personal touch through other means if that indeed is your growth plan?
Time is a factor, right? We all have the same amount of time. It doesn't matter whether it's me or Warren Buffett. It doesn't really matter. It's just how you kind of utilize that time. So one of the things that I started to do early on was utilize different tools, technology to try to minimize some of those times, whether it be a rebalancer, whether it be financial planning tools, whether it be risk analysis tools, portfolio tools, whatever it is. A lot of that stuff we started to adopt early on so we can, focus less time on that and more on the relationships. But that being said, it's a tough thing to do. I mean, you have to make sure that if you went from 100 relationships to 200 relationships, you got to be ready to say, okay, I need to bring someone else on to help with those relationships. I can't just be greedy and say that I'm going to have all 200 relationships. I'm not going to share the wealth type of attitude. And unfortunately, a lot of advisors have that. They just kind of say, oh, I could do this. What's another 100 new households? And then all of a sudden, not only are the new 100 households not happy with the service that they're getting, but your existing 100 households might be now going out the door. And that happens. It's going to happen. So you got to make sure you can have those tools in place and have the right team, which is also tough. I've experienced a lot of team members that have kind of come and gone. They were not the right fit for us. So we've got to make sure that you find the right people. And once you find the right person, hold on to them tight. Make sure they're compensated appropriately. Make sure you are able to give them equity in the firm. That's another thing that's very tough for a lot of advisors. If they grew the firm for 30 years, they're like, this is my baby. I don't want to give this up. But then they shoot themselves in the foot because what happens is at the end of the day, they don't have a succession plan and their assets dwindle away. And they might look at it as, okay, this is better than the Social Security or another pension plan. I'll just hold on to this for as long as possible and while I'm healthy. But those clients are not getting served properly. They're being selfish in that manner. They got to find someone.
Well, it's the ego that you mentioned, right? You talked about the ego. I think the advisor. We've seen in our careers, Jason and I, a lot of ego in that space. And I remember when I started managing the asset management side of the business and less on the private wealth, one of the key issues was like, look, whomever I'm going to give this relationship to is not going to do it as well as I can, but maybe they'll do 80% as well as I did. It turns out that they do a better job because they're more motivated, they have more time, and they actually have a completely different connection. There was that gap where I felt it was really tough for me to even contemplate or accept. And this, I give credit to Mike Philbrick on this, where giving opportunities to younger advisors within your practice, give them a shot, have a couple of introductory sessions, you with them. And what I have found is whatever fear I had, whatever ego I had involved in that relationship was false. And if you want to grow your business, that's what you have to do, right? You have to be able to delegate. And I agree with you. You get the right partner, you get the right employee, you hold on to them tight.
It's funny. So I brought this book along because I thought it might be helpful for your audience. It's not by me. It's by Dan Sullivan and Dr. Benjamin Hardy. It's called Who, Not How. I don't know if you guys have read it. If you haven't, if you're an advisor, if you're a business person, whatever it is, grab this book. It's fantastic. It's going to help you understand how to grow your firm, how to bring on the right people, because ultimately, as entrepreneurs, a lot of times when we're trying to solve a problem, whatever it may be, and I know Raul asked the question here, we think about, how do I do this? The question shouldn't be, how do you do it? It's like, who is the person that you need to get to help do that. And that's what you need to do. And that's what you need to find. And it's tough. You might have to go through 1, 2, 3, 4 people before you find that right person that is going to take the lead. You kind of, whether you want to pass the baton fully or not, but they're going to take the lead and run with it. And you're absolutely right, Rodrigo. I think it's a lot of ego thing. They're like, oh my God, no one else could do a better job than me. And then you come to find out your clients are actually very happy. They're clicking and they know that they're easier to get a hold of. They're very responsive. They're a little bit more tech savvy than you are, or whatever the case is. And they enjoy that relationship. They like knowing that I'm here or I'm behind the scenes and I'm still working with them, with that advisor. And if they need to, I can jump in, or if there's something that's a little bit more complicated, estate planning wise or tax planning, that maybe this advisor is not as seasoned on, I can jump in there. But why don't we look at it the same way as law firms do? You see the partners level, you see the attorneys, then associates and clerks and so forth. I mean, if we kind of try to mirror that in our industry, it would work, but we don't. It's always like a solo practitioner trying to do everything, wearing multiple hats, and then before you know it, it just turns into a failure. So
I've been the strategic coach for years with Dan Sullivan, and I'm a huge fan of anything he produces. And he's so into just understanding your own unique ability, and most importantly, understanding what you're not strong at or what really pulls the juice out of you. And it's important in a team to try to determine, who fits best where. And sometimes you may be surprised for yourself. You're better off in a different spot than you thought you were, and it's a key factor with any team.
And it's perfect that you said that, because the unique ability is what makes a big difference. And maybe this also helps out Raul is, I kind of realized my unique ability was more of the relationship aspect, working with the clients, talking to them, helping them come on to the firm. But my unique ability wasn't necessarily sitting there and doing the financial planning behind the scenes. We can find someone, a team member that maybe doesn't want to be client facing, but would rather be back there crunching the numbers, getting all that stuff ready. And so you got to team up with them and going, is even if that means I make less money, let's say on the client, right? Or I share that revenue, I'd rather get 50% of something than 0% of something.
Right.
So,
and also I think, if I were to, from an external point of view, look at your fortes, I think you have thought outside the box and just the way you communicate on social media, how you bring your community, your California community, you bring them in, you give back to that community, you let know that community that you're helping them out. You talk about you bringing people inside your home so that they know the type of values that you espouse. I think that is really rare for any advisor that I've ever seen. And that requires an entrepreneurial point of view. It requires some deep work that has you completely away from the business at times. And for you to be able to do that, to come up with those ideas, to really move the business forward, you have to be able to delegate. Right? You have to be able to delegate. And to the point of finding your unique ability, as Resolve has grown and partnered up and we brought new people into the firm, I started being everything. I was the advisor, I was the psychologist, I was the trader, I was everything, and slowly giving away those pieces. I got to tell you, audience, every single time I gave away a part of it, I felt like I was cutting off a part of my body, and yet
it's hard.
you end up landing in your sweet spot. And I think in terms of partnership, I also had, prior to meeting these gents, I had a partner that it didn't go well, and the reason it didn't go well is because I partnered with him because he was an identical personality to mine. I thought, if I'm good at this, then we're just gonna crush this business. But it turns out you end up doing the same job. There's too much overlap. If I had one piece of advice in terms of partnering up, is to make sure that you're partnering with people that are very different from you, complementary, so that they're not stepping on each other's toes.
Right.
And it's very common in the asset management business.
Right, having too many cooks in the kitchen, right? So, it happens. It happens. Everyone's kind of like, oh, I want to play that role. And it's like, well, maybe there is not enough business to play that role, and we need to each kind of, divide and conquer. And it's tough. It's tough to find that person, which is why I think finding that individual, if you do, make sure you take care of them. Make sure they understand that they are as important to the firm as you are. And, and that's tough for a lot of advisors to do.
It's tough for anybody to do. And I mean, you got to manage money, you got to manage people, and you got to manage the business in this world. And all three of them require less overlap than you might think.
Right.
Yeah.
Alex, I kind of wanted to shift gears slightly, but still within the topic of behavioral, but bringing it from the abstract to the tangible, I guess. A year like 2020, one of the most, like in living memory, it's hard to think of a more roller coaster year in markets. How was the stick to itness for clients and their portfolios, and how are you able to kind of thread that line when it comes to clients freaking out maybe in Feb, March, and then kind of wanting to maybe go back all in equities, depending on how you guys reposition? How did that play out?
It's funny you mentioned 2020, and two of us grabs a drink right away. Just hearing that.
Right. Pavlovian. For sure.
It just triggered it right away. So look, it was very difficult, not only as an individual investor, but also for professional investors. So it's, we all know greed and fear is what runs the markets. And one of the things that we've done, especially a lot of our clients are older, a little bit more conservative. They're not necessarily looking to kind of juice the portfolios. One of the conversations we had late last year and early this year was to start trimming within the portfolios. In February, when I started paying attention to what was happening with the virus overseas, I knew that this wasn't something that was just going to be a joke and stay there like it did, with some of the other viruses from the past. Was I lucky? Yes. But I kind of, being in the industry for a long time, you start to say, okay, I don't know how this is going to play out. So let's do something. Let's take that into consideration. And part of our portfolios, I don't necessarily buy into you have to be either all active or all passive. We have a blend of things. And then we also have a blend within the different areas. So whether it be in fixed income or equity or alternatives. So we started to take some money off the table on the equity space. I didn't realize we would see that type of a quick V-shaped recovery, but we did. So we didn't experience as much of the downside, but then we started to kind of come back a little bit back into the markets. I don't want to say necessarily we dollar cost average. That wasn't necessarily what we did, but when we saw opportunities, we shifted back into some of the equities that we had taken off. So we took out the choppiness. We kind of tried to help smooth out the ride. And that was something that I did years ago when in 2006, 2007, we started talking to clients like, this is crazy. When your neighbor's telling you that they're on their fifth house that they're buying and they're leveraging to buy another property. I literally told my dad, sell your house. We're getting out of here. I had him sell his property. I'm like, you're never going to get this amount of money again for the rest of your life on this house. And we started talking to clients about this, some of the concerns that we had. And were we early? Yeah, we were early, but I would rather be early to the party than late. And we started to transition. We had kind of more of a core satellite model back then, and we blew out of all the satellites. We held on to our core position, which was about 30-40% of the portfolio. If I'm wrong, I'm wrong. And we'll hold on to it. But we blew out of the satellites that had a lot of emerging markets and foreign debt and so forth. And that worked out for us. And we doubled that year because clients were, a lot of clients were thanking us and talking to their friends that were losing their shirts and saying, hey, you know what, you should talk to my advisor. He explained to us what he was doing. A lot of clients fought with me. I'll be honest. They fought with me. They're like, what are you talking about? Markets can't go down. They only go up. They only look at the upside of things. And we had to explain to them what we were trying to do. And especially if they were going to be retiring anytime soon, people don't think about that. So if our clients, going back to 2020, a lot of them are either existing, retired or about to retire. This is their nest egg. So we had to have a pragmatic approach to it and explain what we're doing. And the communication is key with clients, even if you're wrong, because you're going to be wrong a lot. You want to explain to them kind of the logic behind it. And most clients thanked us for what we did. And it also depends on their time frame, right? So it's different if you're investing with me and you have a 3-year time frame where you say, I'm going to need this money or access it in 3 years, as opposed to I got a 20-30 year time horizon. If it dips down and comes back up, who cares? I'm not really taking advantage of it.
Well, that's an interesting point. Communication, we've always found it very difficult to communicate singularly a single message when you have tiered client bases, right? So I know that you do a newsletter for your advisory practice. How do you deal with communication? What do you handle on your email communication? What do you handle personally, and is there a difference?
So there is a difference. The newsletter is a little bit more generic in nature because of what you just pointed out. Everyone's situation is a little bit different. Everyone's risk tolerance and time frame is a little bit different. So we kind of convey to them what our overall thought is, but that might not particularly hit what they're doing. So if I'm talking about, okay, we're getting back into the markets today, blah blah blah, in the newsletter, but then you're a client that is sitting in munis because you really want no stock exposure whatsoever. It's not going to, right, it's not going to make sense. So then it goes to the communication to that individual client of saying your situation is a little bit different, this is what we're doing. But for those clients that are maybe longer time horizon or want exposure in the markets, that would work for them. So it'll be interesting how this turns out, because one of my goals this year is to have this type of communication with our existing clients, something where I can do a YouTube live stream and have clients now log in, be able to communicate with them, answer the questions on the side, and be able to do it that way. Or now with Zoom, right? I can hold a Zoom meeting and invite 100 clients to it. It might be a little bit crazy, but almost hold like a town hall on a quarterly basis and kind of get an idea of what they're doing. Let them ask questions. Some people are not going to get into the weeds because they don't want their personal information out in the open. That they'll discuss that to you one-on-one. But there could be some questions that they have, like, how is the elections going to affect my portfolio? Should I be concerned that the Democrats won the Senate or whatever? So this type of stuff. I think having this type of medium is good, and that is my goal this coming year, where I'm going to do that. I'm also going to set up a community, an online community for my clients to be able to join, where they'll be able to log in and I can record a video or do it live and tell them what my thoughts are, whether you want to do it on a weekly basis, a monthly basis, whatever it is. And then they can communicate within that community and know that it's secure, as opposed to it being on Facebook or some other social media platform where they're going to say, I don't know who's reading this, I don't know who's seeing this, I don't need anyone else knowing my business. So it'll become more of a secure tool. And I'm working on building that this year.
So you kind of touched on your previous model, core satellite for Holdies. Are you willing to kind of give us a little bit more of how you're currently engaging in that framework for portfolio building? Do you tier it with regards to risk tolerance? And do you also consider the particular tracking error biases that people have in order to build that portfolio for them for starts?
Yeah, so it all starts with the client's risk. We have our models, and then we have to take into consideration what they have as well existing. So if you come to me with a portfolio and you've got a ton of stock from the next company and that has huge amount of gains, I can't just tell you, oh, we're blowing all out of this tomorrow. There's tax consequences there. It's a little bit different if it's in a retirement account and so forth. So we're going to take all of that into consideration and look at the big picture. But we'll start with the risk as well as their time frame and what they're looking to do. And then from there, we have different types of models based on their asset sizes. So we have our core portfolio that is made up majority of ETFs. And that usually is for accounts that are below 250,000. And then on above the 250,000 threshold is our strategic portfolio. That is a combination of individual equities, ETFs, bonds, funds. So kind of we'll see what's the best choice in that space, and we'll do that. But the strategic portfolio, whether it be on a monthly basis or if there's an action, we'll make the strategic changes there, and we can blow out of sectors or countries or whatever it may be. But the core portfolio is more of a rebalancer, kind of like as clients are building their wealth, that will be the space for them.
I've always found it interesting, the different types of advisors and what they lead with when trying to gather clients. A lot of them, old school traders, lead with how they trade. Some lead with financial planning. Others lead with, a combination of both. Where do you see the hierarchy of needs, or at least where do you see the hierarchy of how you sell and gather organic clients?
So when I moved over to American Express Financial Advisors, one of the reasons why I shifted over in '99 is I realized that I don't want to sell products. I don't want that to be the leading conversation. Hey, buy my mutual fund because it's better than your mutual fund. That was not the way I saw the industry going. I wanted to focus on advisory and I wanted to focus on financial planning. So financial planning is still a big focus for us, but the investment world has changed a lot, and you guys will probably see this, whether it be the Robin Hoods of the world or whatever else it may be. That communication, that conversation has changed, where people now are saying, okay, I get it, financial planning, yeah, I got to do it, but I really just want to start investing. I just really want to start saving. Now, it's if they're doing it for greed purposes, and they're just like, I see this stock going higher and higher and I need to get in. That's something different. You need to calm them down and talk them off the ledge, and sometimes you can't. I mean, they're going to do what they're going to do, right? And unfortunately some of those people have to learn by their mistakes, and hopefully change that behavior down the line. But for those that realize, okay, yes, I do want to do this investment, but you have the conversation of why do you want to have that investment? What's the purpose behind it? Well, I don't have anything saved up for retirement. Okay, so maybe we should set up a retirement account, and then you can do those types of things in there, not necessarily in a traditional brokerage account or an online account or whatever it is. So we want to have that conversation. But my point of bringing this up is I realize that our industry is kind of going like this. You're going to either and you guys maybe aren't necessarily on the advising side right now. We're working with, the public, but if you are, you're going to have to start going further and further up the ladder. I think you're going to have to start working with clients that are a little bit more technical in nature, are going to need more, or have more complicated tax needs, have more complicated estate needs. And if you were saying, oh, we don't take clients under $1 million, now you might have to come back and say we don't take clients under $10 million. So I think we're heading in that direction. But what happens there? What about the rest of the investors that are out? They're going to get left behind. And unfortunately, just like we're seeing right now with the middle class, I kind of see that happening in our industry. So you're going to have to come out with the other option, which could be for the clients that are the do-it-yourselfers, but need some sort of advice. Maybe they don't want to necessarily go to YouTube and get some free advice, or go onto TikTok that some guy's yelling at the screen and saying, hey, you should buy this and you should do that, and look, I made 1,000% in these options. They don't want that either. They want to know they can go somewhere and get some decent advice, but maybe they want to do it themselves. So I think you need to provide that service. And that's the other thing we're working on launching this year as well, where we're going to be able to provide that side. Now, if they have more complicated stuff and they need to talk to an advisor, that platform will allow them to either pay on an hourly basis and talk to a CFP, or if they get to a situation where they have graduated, let's say, from there, then they can now start working with Lake Avenue Financial, where they'll have a lot more direct one-on-one. So I think this industry is totally going to go into two different directions, and either you're going to be part of that wave, or it's just going to crash on you.
Very interesting.
Yeah, I see the same thing. There's a lot of advisors now taking $10 million as a minimum ticket, and lots of people are being left behind. But there are a lot of really good tools and some great education. But there's still a pocket in the middle there where people don't want to dive into the great details of a budget. Budgets are the raw material to make all this work. You want to save money, well, you should know, what are you making? What are you spending? Exactly. Every month. Yeah, and a lot of people just don't do that, but
it's hard. I still have clients that have millions of dollars that don't want to do budgeting. I've had to have this conversation with them year after year, even when we give them the tools and the financial planning, and it's like, just link your credit card to this. Like, oh, this is all we got to do. We'll get all the information in your bank account and we'll figure it out. They would rather jump off a bridge. Like, it's just, it's not something that's fun for them. But you said something interesting, because we've kind of prided ourselves for not necessarily having account minimums. There's certain types of accounts, because of where they're at, might have a sort of a minimum, but I've tried to work with all types of clients, and that could be to the detriment of you end up having a lot more clients than you necessarily want. But I'm not the type that's going to say, no, you don't have $1 million, we don't want to talk to you. And I understand why advisors do that. But if But I might have a client that comes in, or a prospective client that comes in and can have 5, 10, $15 million. But if they're totally rude, I don't want to work with them. I would much rather work with the person that's got, $45,000, but they respect my time, they respect my team, and they value what we're saying. I would rather work with them and help them out. So that's been something that I've done. And whether it be, giving back to the community or other stuff, it's like, I feel like financial literacy wise, I rather teach these individuals, what to do with their money and make sure they're not taken advantage of. Unfortunately, a lot of the times people, whether it be, a language barrier or something else, they get taken advantage of, whether it's in the Armenian community, or, my wife is Mexican, in the Mexican community, that happens a lot as well. She will talk to them. Today, she had a conversation with someone that inherited the estate, and he pretty much speaks Spanish and has no idea what to do. Right. So, it's easy for Rosa to get on the phone, talk to him, and make him understand what needs to be done. And he right away, he felt a lot more comfortable than talking to someone and having that language barrier. So it's interesting in how that works.
Yep.
So I kind of want to get back to the advisor practice, specifically on the communication side. You use a lot of platforms to communicate your thoughts and your views: Twitter, LinkedIn, your own website, YouTube. Have you found one platform to be more useful from an advisor practice perspective than others? And then the follow-up question to that will be compliance. How do you deal with that?
Yeah, it depends on what you're looking for, right? So if you're going to Twitter and thinking that it's going to turn into generating a lot of business, you might be wasting your time. Twitter is a great place for me to be able to meet individuals like yourselves, talk to people in my community, learn from them, help out others. So I like that FinTwit community. It's been helpful for that. Another great thing is I kind of look at Twitter as the white pages. Remember that thing that used to be hanging like from the phone booths? Barely, right? But think about it that way. I have access to people I would have never had access to. And because of that, I've been able to connect with reporters, CEOs, and so forth. A lot of them have followed me. We can DM each other. I don't need to even have their phone numbers. I don't need to text them. I don't need to email them. It's direct communication. Twitter's been able to provide that, and it's been very, very powerful. We also utilize Facebook to an extent for Lake Avenue Financial. Now that's a great way to be able to connect to more of the general public, put videos out there, put content out there, and so forth. Instagram is something we started to utilize a little bit now. Still trying to kind of put my head around how does that work best. LinkedIn is fantastic. I have a big following on LinkedIn, and I'm not saying that to brag, but it took me many, many years to get there. And that's also a great way of connecting to professionals in our industry as well as professionals outside of our industry. And
do you find that LinkedIn has, how do you work with LinkedIn? Because you can post, but there's also the publisher, right? That seems to be quite useful. Like what aspect of LinkedIn is unique enough that has been your biggest growth, and what does it allow you to do that other platforms don't?
So it's interesting. You kind of have to post things differently on the different platforms. And I don't know if you guys do that or not, but I traditionally do. Like I'm not going to post a picture, a cat video on LinkedIn. Maybe I'll put that on Instagram or Facebook, right? But so everyone kind of does these things. But going back to your question, LinkedIn's publisher is something that I've considered utilizing. I haven't really. I've done a couple of posts on there, which have been, have gotten real good feedback. But you kind of go back to, do I want to be controlled by this platform? Is it better for me to blog on our platform and then send people to our blog so I can kind of control that, as opposed to be at the mercy of the algorithms? And I'll give you a perfect example. So we used to have a lot more traction on Facebook, being able to do things, and then all of a sudden they changed algorithms and it was over. All of a sudden, 90% drop off of the type of engagement we used to get from the same amount of posts. So do you keep doing that, or do you say, okay, I got to change this and do it somewhere else? But now you're starting to see, especially when it comes to videos, like I post a lot of videos on Twitter, and whether it be the bear in my backyard or whatever else, people respond to that. And if I posted that video on YouTube and then put the YouTube link on Twitter, very little traction. But if I take the actual video and I put it on Facebook, Instagram, Twitter, LinkedIn directly, it gets a lot of traction. So
right. So that's kind of the way the algorithms are trying to get. They want video for engagement, but they also have a particular way of you uploading that video.
Correct.
So that's an interesting tip. Yeah.
So you got to figure out where you want to build your community, right? Whether you want to build your community here on YouTube, then you might focus and put your efforts on YouTube. If you want to build your community on Twitter or Facebook or whatever platform, then that's where I would put my focus on. But I think you also need to kind of control that content, so you can do both, which is what we've done. We can put the blog, on our website, but then we can also put it directly on LinkedIn or whatever the case is to try to get eyeballs there. And you experiment with it, and that's what I've done. And over the course of the years, I've done multiple experiments. To this day, I still do experiments on Twitter. I'll put a post just to see what kind of response it'll get, what kind of results it will get, and I track the engagement and all of that afterwards to say, okay, I know that really didn't work, or this did work. Why did it work? And sometimes you and I might sit there and say, let me write this clever thing on Twitter, and it gets nowhere. And then you write something stupid, and all of a sudden it's getting retweeted and shared, and you're like, well, I spent no time on that, and all of a sudden people loved it and shared it. So
it's totally random. Yeah.
Very random.
Most advisors that I deal with are either unable because of who they work under to do any social media, or are terrified of the compliance repercussions required in order to be able to do what we do. What advice would you give to an advisor practice that's trying to think about social media and compliance?
Well, keeping in mind that this is for the U.S., right? I mean, it's going to change from jurisdiction, but I think probably the U.S. Regulatory landscape is probably on the more draconian side of things. So if it applies there, maybe.
Yeah, I don't know how it is in Canada as far as compliance is concerned. But one of the things to keep in mind is you want to know what those rules are. You don't want to go out there and get in trouble, and all of a sudden your compliance department is, slapping you with a fine or telling you got to shut your Twitter account down and so forth. So if most of the independent broker dealers typically will allow you to use the three major ones, Twitter, LinkedIn, Facebook, right? You need to utilize some sort of a tool that allows them to capture the information and archive it, whether it be like an Erato or Zix or whatever. So as long as you put those things in there, it'll be able to do it. But find out what those rules are at your firm. One of the major reasons why we went independent, besides acquiring practices, was because I kind of saw that we needed to be able to have more freedom. One of the big nightmares, and again, this is not to put down a mirror prize, but I recall many times I had an idea, I had a marketing thing that I wanted to do. Let's say it was, September, and I'm saying, okay, it'll give me enough time. People are going to start worrying about their taxes and so forth. So let me do a letter about tax planning, and I would submit it to compliance, and then, September would pass, October, November, December, blah, blah, blah. And all of a sudden they would respond to me in June saying, we rejected it. It's like, well, thanks. Yeah, thanks a lot. It was all because they wanted to protect that blue box, the American Express box. So it was very hard for them. It was like you had to use their pre-prepared stuff, or it was really tough for them to make an exception. Now, things have probably gotten lax since then, but that was one of the reasons why we went independent. And I push the envelope. I do other things that most even independent broker dealers might not be comfortable with, which is one of the reasons why in April I dropped my securities license. It's like, okay, I don't have to worry about that. Now I just have to make sure my RIA is comfortable. As long as my CCO is comfortable with the stuff I'm doing, and sometimes they're not, I got to make sure that we're on the same page. As long as they're comfortable, we can push that through.
I'm about to post a bear running through my backyard. Is that an A-okay, or should I?
Is this considered an outside business activity?
Yeah, exactly. I remember when we were Macquarie, under the Macquarie umbrella. This is Macquarie Global, based out of Australia. We have a pretty popular blog. In fact, when you looked at Macquarie Canada, our blog, our personal team's blog, would pop up before the Macquarie logo. So we had more hits than anybody else in the organization. And we published our yearly bold, confident, and wrong review. Analysts saying, we believe this to happen. By the end of 2021, we see these targets being hit. And every single time, generally speaking, the vast majority were wrong. And for some reason this year that particular year they weren't approving it. Get on a conference call, get on a conference call with Sydney, trying to figure out what the hell's going on. And then it leaks that they had, at the same time that we were planning on publishing our piece, Macquarie was going to publish their global outlook. And, we were getting, if they were going to, anybody was going to do an organic search, they were going to find us before their outlook. And that was it. We couldn't publish it. And that was one of the major reasons why we got out of there, right?
Yeah, I mean, unless
your
you're on
values
there
go down.
saying ridiculous things, and there's a ton of people that do this, like on Twitter, that we probably see. I just end up kind of rolling my eyes or saying, "Oh man, that's not good." I don't know who's going to get, whether it be their compliance or the Twitter police or whatever it may be. Some people get away with it, and unfortunately, other advisors look and say, "Well, they were able to do it. Why can't I do it?" So that becomes an issue, and every firm is a little bit different. So definitely talk to your compliance officer, your CCO, whatever it may be, and figure out what those rules are and stay within those boundaries. Also, it's tough for people to work on different platforms. Kind of maybe find out what you're trying to accomplish. If your thought is, the only reason I'm interested in, let's say, social media is to get clients, to use it as a prospecting tool, then maybe you got to go to one platform as opposed to the others. If you're saying, I like coming here because I like community and I want to learn things and share and so forth, maybe you go to a different platform. So figuring that out, I think, is real important, because people just say, oh, I want to start something, and then they have no idea what to do. And then they're wondering, why don't I have followers? It's like, well,
it's just interesting. You can tell right away who the social media accounts are when it's been overly reviewed, and you're just towing the line, right? Nobody cares about what your company by a committee feels about at all, right? What they care about is authenticity, being genuine, your personality, right? This is, I think, what show the people that I like in the advisor space on Twitter and LinkedIn. They're putting themselves out there, and it really is like 80% about who you are as a person, what your values are, and 20% have to do with the actual business that we're in. It doesn't need to be 100% financial, right? And I think how you build a brand, how you build a following, how you get your clients to continue to feel that they're in touch with you, even when you've built your business successfully, you're not necessarily in touch with them as it used to be when you only had 2 clients. That's how you do it. I think that's a part that's missing. You don't need to. Absolutely don't need to do that.
It's interesting because a lot of times one of the top things I will hear, whether it be at a conference that I'm at, or even prospective clients, they say, I feel like I already know you and I've never met you in person before, right? Whether it be through social media, whether it be because they watched a video of me, or whether they feel like they got invited into my house when they saw Rosa posting something, or whatever it may be, right? So that part is very, very important, and you have to mix it up. So look at even Mike's Twitter posts. He might be putting some stuff for Resolve, but then he has a picture of himself and his wife, for New Year's or whatever the case is. So, but again, you might not put that on LinkedIn, right? I would maybe put that on LinkedIn and try to keep it more professional in regards to that. And sometimes there might be personal things that I will want to share. Maybe it's something that's important to me. Like I shared this stuff with the community that we were doing and trying to give back, and that gets a lot of people that appreciate
share your values, right?
Right, exactly.
Yeah, authenticity sells for sure in a sort of pasteurized and sort of cookie cutter world where there's so much of the same. Being authentic and just being yourself, it connects with people, as you were saying earlier, Alex.
It also leads to the client base you want, right? And leads to the people you want to be surrounded by. If you're
selection bias,
you're self-selecting at the end of the day.
Yeah,
very true. Very true. I mean, if they've seen my political posts, there's a certain political group that is not going to want to be my client. And you got to be careful. So there's
the Green Party, isn't it?
Yeah, it is. How did you know? but at the end of the day, listen, it's up to you. I chose to be verbal about those types of things. Other people will just stay away from it and avoid it like the plague and say, I don't want to do that. I don't want to have a certain group feel like they're not welcome. I'm not saying that they're not welcome, but I want to be authentic and say, if it's something that I think is important, I'm going to talk about it. Like that was funny enough. My 2021 New Year's resolution was I am not going to do any political posts. And it took 6 days. Like I was already
Every
done.
one of you guys on Twitter that are political and say that, like, you literally last 2 weeks. I don't think I've seen any one of you be like, I'm not going to talk about politics anymore. It's like you just
It's
can't
hard, man. It's
especially in
hard.
the US, right? Like you guys are there's a lot of stuff to talk about.
It's
So before we go
hard.
up, that's very, very slippery slope, and we might choose to go. I just want to ask Alex, in terms of whether it's trends in the industry or just projects that you're currently working on, what's gotten you excited? What are the things that you're sort of looking forward to after a crazy year that's gotten everybody reaching for the drinks when we mentioned 2020? What's 2021 and going forward have in the crosshairs for you in terms of projects, things that are getting you excited?
Yeah, so the two projects that I was talking about is what I'm super excited about. These were things that I wanted to launch last year, but we had to kind of hold off as we let the dust settle and trying to figure out, our bearings of what we're going to do. Right now, I've been working pretty much from home for almost a year now. Been very smooth. Our clients have had no issues with it. But the project that I'm working on will be more of the community for the clients that are, more of the do-it-yourselfer crowd. They want to learn, they want the resources and tools. That's something that we'll be launching soon, and I'll let you guys know more about that. And then also, being able to have more of a presence online, something like this, where we'll have a live stream show, something where I could be able to touch the community and talk to them and share ideas and so forth. So there's a lot of different stuff up in the air right now. I got to make sure that I'm efficient with my time, going back to what we talked about, right? As kind of the leader for the firm, being able to make sure I can focus on different things and nothing falls through the cracks. And it's tough, but if you find the right people to help out along the way, it makes a huge difference.
And how about on the disruption side of things? What are the things that you're sort of looking out for of potential risks or things that you need to keep up with? I mean, the buzzword today is blockchain, distributed ledger, stuff that can be disrupted by this upcoming technology. So, do you have any thoughts on there? And what are the things on your radar?
This is another good conversation because maybe 5-10 years ago we were talking, not maybe not 10, but 5 years ago we were talking about the robo advisors, right? And is that going to put an end to advisors in general? But no, it was a very glorified temp where we can utilize those tools and you can still offer the solutions, but it makes things efficient for you and so forth. But now looking at, there's the discussion of crypto, and I would love to actually get some of your thoughts, if you guys are allowed to talk about it, of where you kind of see where the crypto is going. But I think that needs to be a discussion as well with clients. Now, because of compliance, I haven't necessarily been able to talk to them about it, but I wanted to. Now we got to figure out what's the best way of doing that and discussing that this is just another separate asset class, or maybe they shouldn't consider it an asset class and just forget about it altogether. That could be something that we need to discuss. And then lastly is the conversation we see and we have amongst advisors. If you're on Twitter, people are always discussing how should you be compensated. Is it asset-based management, AUM versus financial planning fees versus monthly retainer fees? Part of that community that I want to build, I want it to be more monthly retainer model, but the monthly retainer model even I think has some broken parts to it, where if you're charging a client $300 a month, $400 a month, whatever it is, that puts you in a position where every month, like an attorney, I got to show what work I did for them, kind of keep track of my hours. And most advisors don't want to do that. That's not what we got into the profession for. So you find a different way of doing it, maybe at a much lower cost, where it's more of a community basis, not necessarily selling a newsletter for a monthly fee or whatever, but something where there's value add and you give them the tools and the resources so they can do a lot of that stuff on their own.
This is for the technical crowd that you were discussing, right? Those that are willing to kind of learn on their own and read and the like.
Good. Listen, if we think about the gym, right? I don't know if they're open in Canada or not, but they're not really open here in LA. So think about the gym. If you work out, you go in there, there's two types of crowds for the most part. There's the crowd that's going to say, I want to go in here. I see the machines and the tools. I know what to do. I'm going to do it on my own. Maybe I do it right. Maybe I do it wrong. Maybe I watched a YouTube video. Maybe I'm using an app to tell me what's the next exercise I should be doing. Then there's the other crowd that is either going to say, I want to step my game up and I need a trainer, right, to hold me accountable and to make sure I'm doing things right. Or I'm never going to show up to the gym if I don't have an appointment with a trainer. So there's those two crowds. And I think that will come to fruition in the financial industry where you can offer those types of services. You don't have to choose one or the other. Some advisors might, and they say, I'm just going to focus on being the trainer and charging for this for the serious people. And that's fine. Some are going to say, I want to be working with the do-it-yourselfers or more volume in that regards. And then I want to be able to do both and give the clients a choice. Like, do you want to be here? Do you want to be here? We offer both options.
Very cool.
Yeah. So if we talk about the crypto, I'm curious to what you guys think about this, because I think it's going to be very disruptive of our industry, and it's going to be very tough, on the greed side of things, whether you believe it's an actual asset class where you actually think there's a store of value or whatever it may be. How do you have that conversation with a client? Do you basically tell them, ignore it, it's the tulip mania and you got nothing to worry about, it's FOMO? I'd love to hear your thoughts on it.
It's been a very heated series of debates in the organization. We're certainly interested, and we see that there's a ton of value. When Canada was the first public fund to launch. Was it 4 Bitcoin? 4 Bitcoins mostly, four cryptocurrencies, and the main one being Bitcoin. Most of the people in the firm bought part of that because they believe in it, and so it is something that you can allocate to clients. Now, I'm not speaking for everybody else in here, but the way I've always seen that type of stuff in Canada, it was always been something, right? It was either the oil and gas stocks in the mid-noughts. It was marijuana stocks recently. Now it's Bitcoin, and Bitcoin, Canadians being the first to be able to invest in this type of stuff. To me, it's playing
through an ETF or through a public vehicle.
Sure. They all have merit as to why,
we've had each.
Whether they were going to succeed and go up and be parabolic or not. But at the end of the day, I've always thought about it as we need to. This is a behavioral game, as we spoke, right? You need to manage the behavior of your clients, and if you think that you're not gonna. If you think you're doing what's best for your clients by denying them a little bit of humanity, you're wrong. You need to set aside some money, give it their play money, and then give them the option to talk about it. You need to be informed about the topic so that when they talk to you as a fiduciary, you should be able to give them some good advice as to what it's all about. And the advice for me is that we really don't know where it's going. It is an emerging technology. It is an emerging asset class. And it's fun to play, but let's make sure we're not putting 50% of our net worth in it, right? That's the way I see it from an investment perspective, from a technology
and understanding the narrative that's driving it, right? Whether it's because people perceive it, whether misplaced or not, as a hedge to inflation. More so, I think it's because of the fear of currency debasement, most particularly after all of the stimuli coming in 2020. But against the US dollar, I think that's what, and I think part of that narrative now has become, okay, institutional money is coming in. They're figuring out the custodial side of things. They're figuring out the regulatory framework. So people are perceiving this as, okay, there's so much money that could come into this space. And that becomes a little bit of that behavioral thing that we were talking about, and that greater fool theory. Okay, I can buy this now and sell it for later. Whether or not there's any intrinsic value, I don't think, I can't think of any framework to decide whether there's any intrinsic value there, but it seems like there's a lot of trend behind it.
Yeah, it's fascinating. I personally had bought some back in 2019. I was interested in it before, but it was kind of is this real? Is this not? Is the SEC going to step in? Is some regulatory body going to step in and put a squash to this? Then there's the concerns about, as powerful as the government is, could they just say, you can't own this, end the story, it's illegal, whatever the case is, and it squashes it. So there's always this risk. And whether it is, as you mentioned, all the other things of people looking at this as a legitimate currency or an alternative or a digital version of gold, or I don't trust what's going on. So there's a lot of that needs to be spoken about. But I agree with Rodrigo, is I think you can have an allocation to this, not a huge allocation, but just something where you can say, okay, as a hedge or as a diversifier, we can have some exposure to it. Whether you tell them to go and buy this with your play money, quote unquote, that could be tough, because then you start to get to the behavioral aspect where people come back and say, look, what have you done for me lately? I know your portfolio went up X, but I did that in a month. In a week at this point, whatever, in my crypto. So why should I just move all of my portfolio there? Tell me why I shouldn't do that.
That's when
it seems like this is
maybe when I just say goodbye. We're done. Yes, you're right. Go ahead and put it all in. I'll give it one more shot and then I'll fire it.
I think these are two separate issues. I think one of them is whether or not crypto has any legitimacy to it, or Bitcoin particularly. The other one is maybe sort of understanding what the particular client's biases are, and maybe setting aside, quote unquote, what you described as play money, and saying, okay, maybe for 1%, 5%, whatever percentage we're going to set aside, a smaller percentage of the portfolio, for them to sort of scratch that itch. And
it's a water cooler. How can you not be able to talk about Bitcoin? It's a water cooler discussion. You have to have a little bit of that.
For sure, but it doesn't have to be. It doesn't have to be Bitcoin. It has to. It was before, as you said, marijuana. Maybe they want to invest a little bit of in marijuana side because they want to have that part of their portfolio and be able to talk about it at dinner parties, whatever the bias is. At the end of the day, understanding the clients.
What I want to start doing is you posted a chart on Slack the other day that I thought was hilarious. Was it soybeans? That soybeans had a more parabolic chart than Bitcoin. Yeah. Right? And next time a client comes out and says, should I buy Bitcoin? I'm like, yeah, Bitcoin's good, but how about this?
Exactly.
How about soybeans?
That's exactly. And corn had one the same. So it's part of that. It's the tongue-in-cheek side of things. Of saying,
and it won't satiate. What they need is to be able to talk about it and brag that they have it.
Put $100 in, and if you're going to take a high risk bet on something, maybe there's a more suitable thing to look at that might benefit your portfolio in a time of distress. Like, how'd Bitcoin do in March?
Right.
It's not going to, but who knows?
And
there's a lot of debate about it right now.
Yeah, I was watching someone major that is always on Twitter talking about Bitcoin, and they brought that up. They're like, if it's supposed to be an asset that has no correlation to the markets, look what happened in March, right? And his response was, yes, it correlated, and so did gold, and so did the bonds, and blah blah blah.
No correlation is not negative correlation. People that's one of the things people don't understand. But
listen, tweeting out that I own a bunch of soybean futures is not sexy on Twitter. It's just not. It's not. But talking about
that was kind of the point. But that was kind of the point when I sent it. I was like, you want to talk about Bitcoin? I just sent this chart on soy. I was like, look at this parabolic rise.
But we might be missing. And again, I'm going to play devil's advocate here. I think we might be missing the point of a lot of the people, and I do believe in this, and it's becoming more and more of a reality, is that this can be the currency of the future, or it can be the currency that other countries utilize. I know one of the other live streams you guys were talking about Argentina, right, recently. So if you're from a country where there's all this huge devaluation of the currency, you're going to say, thank God I owned something else, or a crypto, or I had all my money in euro, or whatever it may be. If you look at it from that aspect, you're going to say those were winners. And now I'm starting to hear, Russia is very interested in Ethereum and Ether as far as the crypto is concerned, and that technology behind it. So who knows where we're going to be? I mean, we might have this conversation 10 years from now and say, oh my God, we talked about this 10 years ago and look what's happened. Or we might be laughing about it. I don't know. I look at it as it's just roulette. You might hit it. It might be big, or just know, I've told some of my friends who've asked me about it, I'm like, whatever you put in here, it might do well, but just also know that whatever you're putting in here, be willing to risk it all.
Yeah, exactly.
That's exactly right. Yeah.
Whatever coin wins, if any of them do, is going to be an emergent phenomenon we never saw coming, right? Things that you've seen with Ripple and what's the other one that's being investigated by the SEC? Like,
XRP.
Yeah, so you get, then you have these, like, all of a sudden the SEC comes in and says, okay, you did something wrong. Nobody understands what happened. That one's gone. We're never going to know in advance. I think if you're going to get exposure to Bitcoin, I don't know,
if they can figure out who Satoshi is, maybe
they'll get a basket of them.
That's what I said. If they could figure out who Satoshi is, maybe they'll go after him or her. But I think that was one of the things with XRP and some of the other ones. They're like, this is a security because you create it afterwards, as opposed to the way Bitcoin works, where it's kind of distributed and everyone's running their nodes and their servers and blah blah blah. It's not one person who just came to the market like an IPO or an ICO, as they would call it, and put it out there. So who knows, man?
Satoshi or not, it's funny you mentioning that. One of the real concerns that I find in this space is the fact that I may get the percentages wrong, but it's rough numbers. I think 3% of the accounts own 90% of the Bitcoins, something along those lines. So there's such a high concentration that it's hard to put a lot of faith.
As far as the market cap you're talking about?
Yeah, as far as the outstanding Bitcoin, I think 3% of the accounts, or a small percentage of the accounts, of the float, controls about 90% of the outstanding coins.
Okay, so you guys understand supply and demand. So, I mean, that's where we end up going. And a lot of these people that are just holding on to their coins forever. And a lot of them, by the way, when we look at that data, we don't even know how accurate that is. And I'm not an expert. I've been teaching myself over the last year a lot of this stuff and kind of reading up on it. But a lot of these people have actually lost the private key. So that stuff is gone forever. Which is the scariest part for me. It's one thing we could talk about fiat currency, and it's like if I can hold a dollar bill or a Canadian bill and say, okay, I know who owns this, it's here, whether it's losing value or not. But if you lose your passwords or token keys or whatever and stuff, and you can't get in, or someone was talking about their hard drive exploded and they just lost it all, it's like,
which goes back to investor education, which is why the fact that Canada has democratized access via ETFs or investment trusts, and the U.S. is still considering that, even though they've already offered futures contracts. But again, it's not for everyone, and for those for those clients that might have a place in their portfolios, it might not be the case that they want to buy Bitcoin outright. They might want to get access indirectly. And I'm sure for a lot of the purists, they'd hear me say this and they just want to shoot me and say, for sure not. You want to hold on to your own coin. The fact that it trades 24/7 as opposed to the exchanges is another variable to be considered.
It's crazy. I'm looking at it sometimes at 2 a.m, like seeing what's going on, right?
Alex, wait.
Your position is probably bigger than it should be, Alex. Just from that comment, I can say.
No, it's more, I'm trying to see if I can find some sort of pattern. Something happens like at 3 a.m. my time, and I'm trying to figure out, I'm like, is it people from New York coming online, or it's the Asian traders is what I've heard. So that's more what I'm doing. I'm trying to just figure it out, but there's no rhyme or reason behind it right now. It's not something that you could put in a chart and say, oh, here's the candlestick. It just doesn't work that way, right? So it's a lot different.
It's a fantastic hobby. Every year one must have something to obsess about. Why not let it be Bitcoin right now, right?
Or
your tequila.
And your tequila.
So those can go together. Doesn't need to be either or.
I think this idea of an alternative currency, certainly from a South American perspective, I've seen it in Peru when inflation was out of control. I completely forgot about this. It just came to me now. But everybody used to have these point cards back like 25 years ago, where depending on how many points you use, you were able to buy goods from different providers. Now the points didn't change. There was no inflation in the point system. So whatever they had in the catalog, you could buy with a certain amount of points. But the currency was doubling and tripling every day.
But that protected
you were able, so people would that would have more value. These point cards would have more value than the currency itself. The idea of finding a way to move away from a centralized government that's screwing it up is always going to be there. And I think Bitcoin, a lot of the other coins have been a godsend to those countries. Africa, right. South America, they're all using it.
Yeah, particularly for the countries where they might be experiencing something akin to a failed state or hyperinflation. Venezuela comes to mind as another South American on the call here. But you have other places that have lived through similar things. That ability not to have to bring all of your cash and put it into gold or precious metals, but actually put it into something that's digital and then flee and get it on the other side of the border. Yeah, there's real value to that, no doubt.
So let's jump ahead real quick. I don't know how much time we have here, but if you
I have about 5 more minutes, and then I got to hop on.
Okay, so if you think about this, and you brought up a very important thing. Forget about the crypto aspect, but if you think about financial technology, which is one of the things that we've been investing for our clients in, a lot of these countries, whether you want to consider them a third world country, a second world country, whatever it is, they basically leapfrogged. Right? It's the same thing that they did with the phones, right? They said, we don't need landlines. We'll just go straight to cell phones. We just put the towers up. So that's the same thing. There's a lot of underbanked and unbanked countries. And a lot of these companies are coming out there with the fintech tools and saying, whether it be Venmos and the Squares and blah, 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 and say, you don't need a bank. You can send money to each other directly through this vehicle. If you got a cell phone, you're good to go. You have a bank in your hand. And I think that's going to be the next disruptor in the space. We've been investing in things like that. We've been investing in the AI space. We've been investing in robotics. So, we add that as a part of our clients' portfolios where you need to look at, okay, this is something that you're not going to touch for the next 10, 20 years. And I think it's interesting to see that playing out, and we've seen it here in the States. We've seen it, all over. And as far as the robotics, I don't know if you guys talk about kind of investing in Japan or something. Who knows? Maybe Japan will come back to its golden years and be able to be kind of a dominant force with a lot of the robotics and stuff that they're building out there.
How about biotech? Do you guys play around in biotech at all?
Little bit. I'm more fascinated with those other three areas that like I said, the fintech, AI, and robotics. That's something I know a lot.
Yeah, you guys have
about.
the FAIR fund, right? So
the Fair Tech Fund. Yeah, so the FAIR, FAIR, fintech, AI, robotics. AI. Yeah, so kind of being able to do it there has been fun for me. It's something that I've invested in a while, and now.
See, I think that is a much more fruitful conversation than the Bitcoin conversation. And we'll hear from it internally as soon as we hang up for saying that.
But I also want to talk, before we go, if we get a chance of talking about giving back. I think a lot of your audience, advisors, we're in a blessed position today. Most of us were not hurt as much as other business owners were, and if we're in a position to be able to give back, I think is something that we need to do. I think we all need to step up and play our part, and do whatever it may be. Whether you help, a business owner that's in need, or whether you help a friend or family member that's in need, or giving back to the homeless community, whatever it is. I think we all need to step up as an industry and do our part.
Well, you know what, man? I've always seen you be willing to stand up publicly about the things that you believe in at what could be a great cost to have an opinion about your values and putting them out there. And I think that bravery in the going out and representing the people that you think should be represented has been really commendable. So I think if anybody can, follow your lead, they should. It takes some guts to be able to do that. And to be, and go out there and make the right moves for your community. And I think it's great for an asset manager, for building a community for your clients and private wealth. You got to get back to that community as much as you can.
You have to. I think there's no way around it. And unfortunately, a lot of people don't think about it, or, to the benefit of most advisors' situation, they don't know how to go about it. It could be as simple as, I don't know in your area, like what's a major market, but like here, whether it be Kroger or Ralph's or Vons or whatever, me and my wife will buy $10 gift cards whenever we go there, and then we'll pass them out. It could be to anyone. If I get off the freeway, there's unfortunately always like a homeless gentleman or someone that's standing there, and I will give it to them and say, listen, go get yourself some food, take care of yourself. And then now we've done the things with the blankets. We bought a bunch of blankets, and I'll keep a whole box of them in my car on the front seat. So if I see someone, I will literally give it to them and say, listen, I know it's a lot colder where you're at. I think it's 74 today here, but still. It can get chilly.
Don't tell me that.
Sorry, man.
I'm going to hand out a blanket to Richard.
Yeah. Have holes in the
But it's little things like that, right? It could be done. It doesn't have to be, I don't want to take on a major scale. Like, you could do it yourself. And I know sometimes I do get flack for people like, why you promoting this, or why are you putting it on Twitter or you're patting yourself on the back. I'm like, this is not what I'm doing. I want people to understand that they can do this as well. They can learn from this. And most of the time people don't know what to do. You could put a little goodie bag. When we used to travel a lot, if I got some extra shampoos or things or whatever, something as simple as body wash, like I'll put them in a Ziploc bag. I don't need that stuff. I will give it to them and say, here you go. I mean, it's just simple things like that could be done.
You're totally right. I was reminded of my mother. We had a car full of toys and bread when we were in Peru. Admittedly, the poverty there at the time was over 60%. So wherever you went, you were surrounded by children, every stop sign. So she was constantly giving out charity in many aspects, right? Coupons for lunches at their local, whatever stops we frequented, we would have an agreement to feed them. So yeah, there's something certain in communities like that. You can certainly do that. And if you have a passion about anything, like my wife has a passion about animals, and she helps. That's what we focus on as a family. That's what our values are about. We love
and animals. That's good if you can get
back on a consistent basis.
Yeah, I don't know if you have children, but if you do, getting them involved is huge, and having them learn about empathy is fantastic. One of the organizations that actually reached out to me is called Blankets for All, and they basically do something where they will allow the schools to create this little kind of fundraiser, and the kids will write a note to the homeless people, talking about empathy. And they go through a whole exercise, about an hour. They'll close their eyes and imagine if they were homeless, what they would do, what they feel, and so forth, and kind of write their feelings down there. And they will take that note along with a blanket and either directly give it to homeless people or take it to the nearest homeless shelter. And that's the one way for them to understand and be a little bit more humble and to learn about empathy and caring. And that's fantastic. So there's organizations like that I'm going to start working with this year as well, going back to what am I excited with
that's
about.
Exciting.
Yeah, and just help them and kind of partner up with schools here in Los Angeles and schools throughout the nation.
Well, Alex, thanks so much for joining us today, man. That was a wealth of information. Hopefully our advisor group is able to take something away from it. Cheers, gentlemen.
I've finished my drink, so cheers.
Have a fantastic weekend, and we'll hopefully see you again in the next Intuit event.
Yeah, this was a lot of fun. Thanks, Alex.
Thanks you for having me, guys.
Great.
Bye-bye.
All right,
Cheers.
bye.
Cheers.
Today's podcast is brought to you by Horizon's Resolve Adaptive Asset Allocation ETF, which trades on the Toronto Stock Exchange under the ticker symbol HRAA and is sub-advised by Resolve Asset Management. HRAA is an alternative fund whose investment objective is to seek long-term capital appreciation by investing, directly or indirectly, in major global asset classes, including, but not limited to, equity indices, fixed income indices, interest rates, commodities, and currencies. HRAA gains exposure to these asset classes by investing in derivative instruments that may include future contracts and forward agreements and securities. HRAA will take long or short positions, using up to a maximum of 3 times leverage in asset classes such as equity indices and fixed income asset classes, commodities, currencies, volatility indices, and other alternative asset classes. HRAA could provide balance to your portfolio by harnessing 3 unique investment styles. The first is an actively managed global risk parity portfolio to provide maximally diversified global exposure in optimal risk balance. The second is a proprietary systematic global macro process that attempts to profit from short-term market moves, going both long and short on more than 50 global markets. Finally, HRAA uses a dynamic tail protection overlay that attempts to profit from large moves in volatility markets. To learn more about this, please visit www.horizonsetfs.com/HRAA to read about the ETF's investment objectives and important disclaimers about the risks associated with an investment in the ETF.